$200,000 in 5 top Fidelity Index Funds. What will happen in 30 years? Alex takes the same $200,000, invests it in the same 5 funds, and gets 2 completely different results. In the first scenario, after 30 years, $6,273 comes into his account every month. Automatically, without selling a single stock, just money that comes in, because that's how the system works. In the second scenario, the same 5 funds, the same $200,000 at the start, but a different distribution between them. And after 30 years, the account shows almost $13 million. Not because Alex predicted a trend, not because he got lucky with a stock, because he made one single decision at the very beginning and let the math do the rest. Most people, when they hear about index funds, nod and say, "Yeah, I've heard of them." And yet, they either do nothing or make the most common mistake. They choose funds and then never think about how exactly they distribute their money among them. Meanwhile, it is this distribution, not the funds themselves, not the entry point, not macroeconomics, that determines the difference between $6.5 million and $12.8 million at the finish line. Today, we'll examine both options in detail. 5 funds, what they are, how they work internally, and why Alex chose them. Then, 2 portfolios from these same 5, one focused on income, the other on maximum growth. And finally, an honest discussion about which one is really right for you, because the right answer here depends not on math, but on what you want from your money. But first, why index funds, and why they work this way? Before we dive into specific funds, we need to understand the underlying idea behind this entire strategy. Most people think of investing as picking the right stocks, find an undervalued company, buy it before everyone else realizes it, sell it at the peak, and you're in. It's a beautiful and intuitive idea. It also doesn't work for the vast majority of people who try it, not because they're not smart enough, but because the entire market is stacked against them. Thousands of professional analysts, algorithms, and inside information that a private investor inherently lacks. Study after study shows the same thing. Over 90% of actively managed funds underperform the market over the long term. An index fund is a fundamentally different approach. Instead of picking winners, you simply buy the entire market. The fund follows an index, a set of stocks with clear inclusion rules, and holds everything in that index. No one picks stocks. No one actively trades. That's why fees on these funds are close to zero, literally hundredths of a percent per year. And that's precisely why they outperform most active managers over long horizons. Fidelity Index Funds are among the most well-known in the world. Some of them charge virtually no commission at all, and Alex chooses exactly 5 from their lineup, each with a specific portfolio function. Not because it's a magic number, because every healthy portfolio has several objectives, and these 5 cover them completely. The first task is an anchor, a stable core for the American economy. The second is a growth engine. The third is a bet on the future. Companies that aren't yet in the rankings, but could end up there. The fourth is income, cash right now. The fifth is diversification, because no country leads forever. 5 tasks, 5 funds. Fund 1. FXAIX is the anchor without which nothing can be built. FX, ABOR-SIX, is the Fidelity 500 Index Fund. It tracks the S&P 500, the 500 largest publicly traded companies in the United States, weighted by market capitalization. When the news says the market is up 1.2%, it's usually the S&P 500 that's being talked about. It's what most people think of when they think of the market. The fund is filled with household names: NVIDIA, Apple, Microsoft, Amazon, MetaTrader, Alphabet, and Berkshire Hathaway. The technology sector accounts for more than a third of the fund. It's important to understand that the S&P 500 today isn't a uniform cross-section of the American economy. It's a cross-section where a few tech giants carry a disproportionately large weight. When technology grows, FXAIX outperforms expectations. When it corrects, the fund feels it more than it initially appears. But over the long term, the S&P 500 remains the benchmark. The average annual return over the past several decades has been around 10%, including reinvested dividends. FXA ICAC's dividend yield is 1.06% per annum. The annual dividend growth rate is approximately 6.84%. The average annual share price increase is 13.54%. This last figure is the comparison rate by which all other funds in this portfolio are measured. Alex chooses FXAIX first and foremost without hesitation. When you're building something for the long term, this fund is the foundation upon which everything else rests. It's worth explaining what a dividend is, as this word will come up frequently. A dividend is a portion of a company's profits that it pays out to its shareholders. You own a share, the company has made money, and it distributes part of that money among those who hold its shares. This typically happens quarterly. The more shares you hold, the larger your check. Dividends can be received in cash or automatically reinvested back into shares. The latter option is more powerful in the long term. Every share purchased with dividends automatically begins paying dividends, and this effect only really begins to add up over the years. Fund 2. FNCMX is the engine that soars above all in good times. FNCMX is the Fidelity NASDAQ Composite Index Fund. If FXAIX is the anchor, this fund is the engine. It tracks the NASDAQ Composite Index, approximately 3,000 companies listed on the NASDAQ exchange. An important detail that's often confused: NASDAQ isn't a company or a fund. It's an exchange. It just so happens that most of the world's largest tech companies have chosen to list on it. Therefore, any fund that follows NASDAQ is automatically overweight in the tech sector. FNCMX contains the same familiar names: NVIDIA, Apple, Microsoft, Amazon, Alphabet. But the weightings are fundamentally different than in FXAIX. NVIDIA accounts for over 11% of the entire fund. The top 10 positions account for almost 59% of the total. So, by buying FNCMX, you're technically holding 3,000 companies, but in reality, you're placing a very concentrated bet on a dozen tech giants with a long tail of smaller names behind them. This concentration works both ways. When big tech rises, FNCMX outperforms almost everything. When tech declines, this fund feels it first and most powerfully. Alex chooses it as a growth bet, and one number justifies this choice completely. The average annual share price increase is 17.95%. This is the highest figure among all 5 funds in this portfolio. FNCMX's dividend yield is modest, 0.47%. Dividend growth is 6.91% per year. But for a growth portfolio, it's the 17.95% figure that really does the trick. Fund 3. FSSNX, a bet on companies that haven't yet become giants. FSSNX is the Fidelity Small Cap Index Fund, and to understand why you need it, just look at its top holdings. Bloom Energy, Core Molding Technologies, Fabrinet. If you haven't heard of any of these names, great, that's the whole point of the fund. FSSNX tracks the Russell 2000 index, about 2,000 small American companies too small to be included in the S&P 500. Unlike FNCMX, there's no concentration. The top 10 positions account for less than 6% of the fund. No single company moves the needle. It's literally 2,000 small bets spread thinly. The logic is simple. Every company now worth billions in the S&P 500 was once small. Amazon was a small online bookstore. NVIDIA was a small gaming chip maker. FSSNSX is Alex's bet that several companies from these 2,000 will emerge as emerging giants in 20 to 30 years. It's important to be honest about the numbers. FSSNX has averaged 9.6% annual share price growth, making it the lowest growth rate among the American funds in this portfolio. Small companies have actually lagged large companies over the past decade. So why hold it? Not because the track record is convincing, but because it's the one corner of the portfolio where the other 4 funds fall short. Alex holds it deliberately as a bet, not out of certainty. FSSNX's dividend yield is 0.89%, with dividend growth of 7.44% per year. Fund number 4, FSPSX, is the highest yielding fund in the portfolio, and it's not American. FSPSX is the Fidelity International Index Fund. And this is the fund that surprised Alex the most because the highest yielding of the 5 wasn't American. FSPSX tracks the MSCEIEAFE index, which represents developed markets outside the US, Japan, the UK, Germany, Switzerland, Australia, France. Established economies, large, stable companies, names many are only half aware of: Nestlé, Roche, AstraZeneca, HSBC, and among them is ASML, a Dutch company most people haven't heard of, but which produces the only machines in the world precise enough to print modern chips. They don't make the chips themselves, they make the machines without which chips are impossible. A monopoly on the critical technology that underlies all modern electronics. FSPSX serves 2 functions in Alex's portfolio. The first is income. Its dividend yield is 5.8% per annum. That's more than 3 times higher than the next highest yielding fund on this list. The second is insurance. If the U.S. market enters a prolonged downturn, the international fund doesn't fall along with it because it's not tied to the U.S. FSPSX's average annual share price growth is 7%. Its dividend growth is 6.85% per year. This is the tension. The fund pays the most, but grows the slowest. It offers the best income and the weakest growth in one package. This contradiction is precisely what determines how Alex uses it in 2 different portfolios. Fund 5, FPADX, covers emerging markets with the fastest dividend growth. FPADX is the Fidelity Emerging Markets Index Fund, and it's the most honest contradiction in this portfolio. On the one hand, it's one of the worst performing corners of the market over the past decade. On the other, it has the fastest dividend growth of all 5 funds. Both facts are true simultaneously. Emerging markets are economies that haven't yet reached their full size: Taiwan, South Korea, China, India. About 80% of the fund is concentrated in Asia, and there's a concentration here that's worth noting. And Taiwan Semiconductor, manufacturing company, a company that takes machines like ASML and literally produces chips for the entire world, accounts for more than 14% of the entire fund. One company on one island makes up 1/7 of the entire fund. After that comes Samsung, SK Hynix, Tencent, Alibaba, all giants. None are American. There's an interesting detail that's easy to miss. Nvidia is the mainstay of the American portfolio. ASML is the mainstay of the European one. Taiwan Semiconductor is the mainstay of the Asian one. Semiconductors underpin every corner of this portfolio on every continent. The entire modern world runs on chips, and this is reflected in the global market structure. FPADX's dividend yield is 1.91%. Its annual dividend growth is 11.01%. This is the highest dividend growth rate of all 5 funds. The average annual share price increase is 7.71%. Alex holds it not for the current yield, but because its dividends grow the fastest. In a long-term income portfolio, this means that over time, this fund begins to pay out more. 5 funds, 5 roles are completely covered: anchor, engine, futures, income, global insurance. But here's the real secret of this strategy, and this is where most people make a mistake. Choosing funds is the easy part. The decision that really changes everything is how you allocate them. The same 5 funds, the same $200,000, but 2 fundamentally different decisions about how much money goes into each, and the resulting account size is almost twice as big. This isn't an exaggeration, it's arithmetic. And that's precisely why asset allocation is the most important decision in investing. More important than choosing specific stocks. More important than the entry point. More important than any forecast. Alex is building 2 portfolios. The first is focused on income. Money flows into the account every month without requiring the sale of a single share. The second is focused on maximum growth. After 30 years, the account reaches almost $13 million, but the ongoing payouts are minimal. Both use the same 5 funds. Only the weightings are distributed in opposite directions. Portfolio 1 is a dividend system, the system that pays Alex monthly. Here's how $200,000 is allocated in the dividend version. 35%, $70,000, goes to FSPSX, an international fund. It's the biggest chunk, and it's there because it's the fund that writes the checks. The 5.8% dividend yield is real money flowing into Alex's account. 20%, $40,000, goes to FPADX, an emerging markets fund. This is the bet with the fastest dividend growth in the portfolio, at 11% annually. This is important in an income portfolio. Over time, this is the fund that will grow the monthly check the fastest. 20%, another $40,000, goes to FXAIX, the S&P 500. The anchor remains the anchor. It keeps everything in large American companies. 15%, $30,000, goes to FNCMX, the growth engine. Even in an income portfolio, Alex doesn't want the account to just sit stagnant. Growth is needed, just not as a top priority. And the last 10%, $20,000, are in FSSNX, small companies. The weighting is minimal because in a portfolio built on payouts, long-term rates are held steady. What's interesting about this distribution is that if you add up all the American funds, FXAIX, FNCMX, and FSSNX, you get 45%. The two international funds add up to 55%. So, this isn't a portfolio that's biased away from America. It's a portfolio where the higher-yielding parts of the world get a slightly larger weighting, even though almost half the money stays at home. Averaging the performance of all 5 funds, taking their weightings into account, the dividend portfolio looks like this: 2.78% annual yield, 7.75% annual dividend growth, and 10.35% average annual share price growth. Now, what does this mean for Alex in numbers? After the first year, the account grows to $226,272. Nothing impressive. That's how it should be at the start. After 10 years, it's $668,839. After 20, it's $2,125,315. And after 30 years, the dividend portfolio reaches $6,492,396. And here's the most important thing. By this point, the portfolio is generating $75,282 per year in dividends. That's $6,273 per month every month without selling a single share. The money just keeps coming. The account doesn't shrink. It keeps growing. Alex doesn't touch the capital. He lives off what the capital produces. Of the approximately $6.29 million the portfolio will add beyond the initial $200,000, about $5.45 million will come from stock appreciation. Another $839,000 will come from reinvested dividends. This is the mechanism of compound interest in action. Every reinvested dividend buys new shares, which pay their own dividends, which buy more shares. Over a 30-year horizon, this snowball effect becomes very noticeable. The second portfolio is a growth one. Almost $13 million out of the same $200,000. Now Alex takes the same 5 funds and reverses the logic. The goal isn't monthly income, but the maximum account size in 30 years. Here's what the distribution looks like in a growth portfolio. 50% ASY $100,000 goes into FNCMX. Half the entire portfolio goes into the engine with the highest growth of 17.95% per annum. This is an aggressive bet, and it was made deliberately. 25% sobbed $50,000. Chia in FXAIX. The anchor remains, but now it's larger because the S&P 500 adds stability to the highly concentrated bet on the NASDAQ. 10%, $20,000 in FSSNX small companies. The same long shot, the same size as the dividend option. 10% boss, $20,000 dixt in FPADX emerging markets. The bet on Asian growth remains on the table, and just 5%, 10,000 in FSPSX. The international fund, which was the star of the income portfolio, is now shrunk to its minimum. At this weight, it no longer pays bills. It's simply a small hedge against a bad period in the American market. Notice what happened to the two international funds. Income accounts for 55% of the total portfolio. Growth accounts for only 15%. They've literally swapped places with the American growth funds. Now the portfolio is 85% American and focused almost entirely on value growth, not current income. The average growth portfolio's performance: 1.07% annual yield, 7.35% annual dividend growth, and 14.44% average annual share price growth. It's that last number that does all the work. Growth portfolio dynamics by year. After 1 year, $231,022, slightly more than the income version, but the difference is small. After 10 years, $825,205. Already a noticeable gap. After 20, $3,285,871. The gap accelerates with each decade. After 30 years, $12,862,188. Almost $13 million. Of this $12.66 million increase, about $12.47 million is pure share price growth. Dividends added only about $197,000. This is almost 98% pure price growth and almost no income. This is reflected in the current payments. By year 30, this portfolio pays Alex $14,244 per year. That is only $1,187 per month. 5 times less than the dividend portfolio. 2 portfolios, 2 results, and the question that is usually asked in this place. So, Alex faces 2 options. The dividend option, $6.49 million after 30 years, $6,273 per month without selling shares. The growth option, $12.86 million after 30 years, $1,187 per month from dividends. The one that has almost doubled in value pays almost 5 times less. And at this point, many people think, wait, if the growth portfolio has almost $13 million, can't they just sell a little at a time and live much better? This is where the 4% rule comes in. The 4% rule is a standard guideline for investing in life. The idea is simple. If you withdraw no more than 4% of your portfolio annually, your portfolio will likely last 30 years without depleting. Applying this to the growth model, 4% of $12.86 million is $514,487 per year, or $42,874 per month. This is a fantastic number, almost 7 times more than the $6,273 from a dividend portfolio. If the goal is the maximum amount you can spend in retirement, a growth portfolio with the 4% rule wins hands down. A more conservative option is to withdraw 3% per year. That's $32,155 per month. Still, it's incomparably more. In good market years, you can take a little more. In bad ones, a little less. A larger account has significantly more flexibility. But there's one thing the 4% rule can't get around, and it's precisely this that explains why the dividend portfolio exists as a separate strategy: selling. The $42,874 per month from the growth portfolio only exists if Alex sells a chunk of his shares each year. He slowly drains the account to pay himself. Meanwhile, the dividend portfolio works differently. The $6,273 per month is a payout that happens automatically as long as each share remains in place. The account doesn't shrink. It keeps growing. Alex doesn't sell anything. And here's where this distinction becomes critical. Imagine The market crashes 30% in Alex's first year of retirement, just when he's starting to live off his investments. With a growth portfolio and the 4% rule, this is a disaster. He needs to sell stocks at the bottom to cover his balances. He locks in losses that can never be recouped. This is called sequence of returns risk, and it's why people retire with huge balances and still end up with nothing. A dividend portfolio doesn't care what the market did this quarter. The dividends keep coming. Companies, especially established international ones, which form the core of the dividend portfolio, pay even in bad years. Alex doesn't touch the balance. He just collects. Which one to choose? And why the honest answer sounds awkward, both. That's an honest answer. Not because it's evasive, because the right choice depends on what you want. And that's a question everyone should ask themselves before looking at any numbers. If you want the maximum account size by a certain date, go with a growth portfolio. If you're comfortable selling stocks gradually and understand the risk of a bad start, a growth portfolio with a 4% or 3% rule gives you significantly more money to spend. If you want money to come in automatically without having to sell anything, go with a dividend portfolio. If the idea of selling stocks to live makes you uncomfortable, go with a dividend portfolio. If you plan to leave money to your heirs and don't need to spend the capital yourself, go with a dividend portfolio that continues to grow untouched. If you need maximum flexibility and are prepared to actively manage withdrawals, go with a growth portfolio. One option is a large pile that you gradually clear out. The other is a monthly check while the account sits untouched and continues to grow. Alex's real decision isn't which funds to choose, but what do I want from this money in 30 years? Math is equally powerful in both directions. The only question is where you direct it. The best time to start is the one you have. Every year you delay is a year when compound interest could have worked for you, but didn't.